Financial crises are inevitable, and history has shown that economic downturns can wipe out fortunes overnight. From stock market crashes to housing bubbles and inflation surges, unexpected events can leave even the wealthiest individuals struggling to recover. However, those who understand the principles of wealth protection know how to safeguard their assets and emerge from financial turmoil even stronger. The secret lies in strategic planning, smart investments, and adopting habits that minimize risk while maximizing security. While most people panic during financial crises, the wealthy follow a different approach. They prepare in advance, ensuring their money is shielded from volatility. They diversify their investments, build emergency reserves, and take advantage of downturns instead of fearing them. Economic uncertainty may be unavoidable, but losing everything isn't. By learning the secrets of financial protection, you can keep your wealth secure no matter what happens in the global economy. In this guide, we'll reveal 6 powerful strategies that the rich use to protect their money from financial crises. 1. Diversifying investments to reduce risk. One of the biggest mistakes people make is putting all their money in a single investment, whether it's stocks, real estate, or a business. While these assets can generate significant returns, relying on just one source of wealth leaves you vulnerable when the market shifts. The wealthy understand the importance of diversification, spreading their investments across different industries, asset classes, and geographical regions to reduce risk. When one sector underperforms, their other assets continue generating returns, ensuring financial stability. A well-diversified portfolio includes stocks, bonds, real estate, commodities, and even alternative investments like gold or cryptocurrency. Additionally, investing in international markets protects against local economic downturns. By not relying too heavily on one asset, you reduce the chances of losing everything during a crisis. This strategy not only preserves wealth but also positions you to take advantage of market recoveries. Diversification is one of the most powerful ways to shield your finances from unexpected economic shocks. A well-diversified portfolio includes a mix of stocks, bonds, real estate, commodities, and alternative investments like gold, cryptocurrency, and even private equity. Stocks offer high growth potential but come with volatility, while bonds provide stability and consistent returns. Real estate generates passive income and appreciates over time, acting as a hedge against inflation. Commodities like gold and silver retain value during economic downturns, offering security when markets crash. Additionally, investing in international markets protects against localized economic recessions, ensuring that wealth continues to grow even when one region struggles. The wealthy also diversify their income sources, creating multiple revenue streams through businesses, royalties, and dividend-paying investments. By not relying too heavily on one asset or income source, they minimize risk and increase financial resilience. This strategy not only preserves wealth but also positions investors to capitalize on market recoveries, allowing them to buy undervalued assets and grow their fortunes even during crises. 2. Building an emergency fund to stay prepared. Many people underestimate the importance of having an emergency fund, but financial crises often hit when least expected. Whether it's a job loss, medical emergency, or stock market crash, having cash reserves ensures you can weather tough times without liquidating investments at a loss. The wealthy maintain a cash buffer that allows them to cover essential expenses and even take advantage of economic downturns to buy undervalued assets. Financial experts recommend setting aside at least 6 to 12 months' worth of living expenses in a liquid, easily accessible account. This ensures that when a crisis hits, you can sustain yourself without falling into debt or selling investments at a bad time. While most people live paycheck to paycheck, those who prioritize financial security always have reserves to fall back on. An emergency fund is your first line of defense against financial instability. The wealthy don't just save money for emergencies, they strategically allocate their reserves in a way that maximizes both security and opportunity. Instead of keeping all their cash in a low-yield savings account, they often place portions of their emergency fund in high-yield savings accounts, money market funds, or short-term government bonds. This way, their reserves are not only protected but also earning interest over time. Additionally, they structure their finances in layers, keeping enough cash readily available for immediate needs while allowing other portions to grow in low-risk investments that can be accessed if necessary. Beyond just covering basic expenses, an emergency fund gives the wealthy a major advantage during economic downturns. While others are forced to sell assets at a loss or go into debt, those with strong cash reserves can capitalize on opportunities, buying stocks, real estate, or businesses when prices drop. This is how the rich often emerge from financial crises even wealthier than before. By maintaining a well-structured emergency fund, they don't just survive economic downturns, they use them to grow their wealth. 3. Protecting wealth with multiple income streams relying on a single source of income is a dangerous financial habit. If a crisis affects your job, business, or investments, your entire livelihood could be at risk. The wealthy protect themselves by creating multiple income streams, ensuring that they are never dependent on just one source. This includes passive income from dividends, rental properties, side businesses, or even digital assets that generate cash flow without constant effort. Diversifying income not only increases financial security but also provides opportunities to grow wealth even during tough times. While some industries suffer in economic downturns, others thrive. Having money coming in from different sources ensures that no single crisis can destroy your financial stability. The key to long-term financial resilience is making sure your money flows from multiple directions. The wealthy don't just focus on earning income, they focus on building assets that generate money even when they aren't actively working. Instead of relying solely on a paycheck, they invest in revenue-generating opportunities that continue to bring in cash no matter the economic climate. This includes everything from rental income and stock dividends to royalties from intellectual property, automated online businesses, and interest from lending platforms. The goal is to create financial systems that work for them, allowing wealth to grow with minimal direct involvement. Another advantage of having multiple income streams is the ability to reinvest earnings into new opportunities. For example, income from real estate can be used to buy more properties, dividends can be reinvested into stocks, and profits from a side business can fund new ventures. This self-sustaining cycle allows the wealthy to multiply their earnings and build a financial safety net that keeps them secure in any economic situation. True financial freedom comes not from working harder but from ensuring that money continues to flow in, even when markets fluctuate or personal circumstances change. 4. Investing in recession-proof assets during economic downturns. Some investments lose value rapidly, while others remain stable or even increase in worth. The wealthy focus on acquiring recession-proof assets that perform well regardless of market conditions. These include essentials such as food, healthcare, and utilities, as well as stable investments like gold, government bonds, and rental properties. Real estate in high-demand locations often retains its value, while precious metals like gold and silver act as safe haven assets when markets crash. Dividend-paying stocks in strong industries continue generating income even in recessions. Understanding which investments hold their value during crises allows you to position yourself for financial security and even capitalize on downturns by purchasing undervalued assets. 5. Using smart debt management strategies. Debt can either be a tool for wealth building or a financial trap, depending on how it's managed. During crises, those who are over-leveraged with excessive debt struggle to keep up with payments, often losing assets in the process. The wealthy use debt strategically, ensuring that they borrow only for investments that generate income, such as rental properties or business expansions. They also keep a healthy debt-to-income ratio and avoid unnecessary liabilities that could become a burden in tough times. One powerful strategy is refinancing debt when interest rates are low, reducing monthly obligations and freeing up cash flow. Another tactic is using good debt, like low-interest loans, to invest in appreciating assets while paying off high-interest debt aggressively. By managing debt wisely, you can avoid financial strain during downturns and maintain long-term financial stability. 6. Taking advantage of market downturns. While most people panic and sell assets at a loss during financial crises, the wealthy see downturns as opportunities to buy at a discount. Market crashes create prime conditions for acquiring undervalued stocks, real estate, and businesses at significantly reduced prices. Those who have cash reserves and a strategic mindset use these moments to expand their wealth rather than suffer losses. Warren Buffett's famous advice, "Be fearful when others are greedy and greedy when others are fearful," perfectly captures this approach. Instead of reacting emotionally, the wealthy analyze market trends, identify strong assets, and make calculated investments. Economic downturns don't last forever, and those who buy wisely during the crisis often see their wealth multiply when the market recovers. 7. The power of offshore and tax-advantaged accounts. Wealthy individuals understand that protecting wealth isn't just about growing it, it's also about keeping more of what they earn. Taxes can take a significant portion of wealth, especially in times of financial crises when governments increase taxation to cover deficits. One of the key strategies the rich use to safeguard their money is placing it in tax-advantaged and offshore accounts, ensuring that they legally minimize their tax burden while maintaining financial flexibility. Offshore accounts in tax-friendly jurisdictions allow individuals to shield a portion of their assets from excessive taxation and economic instability in their home countries. Many multinational corporations and high-net-worth individuals take advantage of these legal structures to store wealth in countries with lower tax rates, financial privacy protections, and economic stability. Tax-advantaged retirement accounts, trusts, and life insurance policies also play a crucial role in wealth protection, allowing money to grow tax-free or at reduced tax rates over time. For everyday individuals, taking advantage of tax-deferred investment accounts, municipal bonds, and legal tax deductions can make a huge difference in wealth preservation. While governments may change tax laws, those who understand how to legally optimize their tax strategy can protect and grow their wealth without unnecessary losses. The key is to be proactive, working with financial professionals to structure assets in a way that maximizes returns while minimizing liabilities. 8. Investing in hard assets to preserve wealth. In times of financial instability, paper money can lose value quickly, and inflation can erode purchasing power. This is why the wealthy don't rely solely on cash savings or digital assets. They diversify into hard assets like real estate, gold, silver, and rare collectibles that maintain their value even during crises. Unlike stocks, which can fluctuate wildly, or bank accounts, which are subject to inflation risks, hard assets provide a physical store of value that remains stable over time. Real estate, in particular, is one of the most trusted forms of wealth preservation. Land and property in high-demand areas tend to appreciate in value, providing rental income and acting as a hedge against inflation. During financial crises, housing prices may dip temporarily, but prime real estate usually recovers and continues to grow in value. Wealthy individuals also invest in tangible commodities like gold, which has been a safe haven asset for centuries, holding its purchasing power even in times of economic collapse. Beyond gold and real estate, rare collectibles such as fine art, vintage cars, and rare watches have become alternative investment vehicles for the ultra-wealthy. These assets often appreciate in value over time and are less affected by stock market volatility. While these investments may not generate immediate cash flow, they serve as a long-term hedge against financial downturns. Those who incorporate hard assets into their wealth protection strategy ensure that their financial future remains stable regardless of market conditions. 9. Establishing strong legal and financial safeguards. One of the most overlooked aspects of wealth protection is legal security. Many individuals accumulate wealth but fail to put proper legal protections in place, leaving their assets vulnerable to lawsuits, creditors, and financial losses due to unforeseen events. The wealthy take steps to legally safeguard their assets by using trusts, estate planning, and asset protection strategies that shield their wealth from unnecessary risks. Trusts are a powerful tool used by high-net-worth individuals to protect assets from legal claims and taxation while ensuring that wealth is preserved for future generations. By placing assets in irrevocable trusts, individuals can legally remove them from their taxable estate while still maintaining control over how they are distributed. These legal structures also prevent assets from being seized in lawsuits or government claims, providing long-term financial security. Another critical aspect of wealth protection is liability insurance. The wealthy don't take unnecessary risks. They ensure that they have comprehensive coverage for their businesses, properties, and personal assets. Umbrella insurance policies provide extra layers of protection, covering legal costs and shielding assets from unexpected financial threats. By proactively setting up legal and financial safeguards, individuals can ensure that their wealth remains intact, no matter what challenges arise. 10. Mastering the psychology of wealth and crisis management beyond financial strategies. One of the most important wealth protection secrets is mastering the psychology of money. Financial crises don't just affect bank accounts, they create panic, fear, and uncertainty that can lead to poor financial decisions. The wealthy understand that emotional discipline is just as critical as financial knowledge when it comes to surviving economic downturns. Those who panic and make hasty decisions often lose the most during crises, while those who stay calm and strategic emerge stronger. A key principle of financial psychology is learning to separate emotions from investment decisions. When markets crash, many people sell their assets in fear, locking in losses and missing out on future recoveries. Wealthy individuals, however, follow long-term strategies and remain patient, knowing that downturns are temporary and can even present buying opportunities. They train themselves to view crises as cycles rather than permanent catastrophes, ensuring that they make rational choices rather than emotional ones. Additionally, mindset plays a crucial role in financial resilience. While some people see crises as the end of financial stability, the wealthy see them as moments of transformation. They understand that recessions create opportunities for growth, innovation, and strategic investments. By continuously educating themselves, adapting to economic changes, and maintaining a long-term vision, they protect their wealth not just with financial tactics but with a resilient mindset that keeps them ahead of the game. Protecting wealth isn't about avoiding risks, it's about preparing for them in advance. Financial crises are inevitable, but they don't have to destroy your financial future. By diversifying your investments, building emergency reserves, creating multiple income streams, and managing debt wisely, you can shield your wealth from economic downturns. The wealthy don't wait for crises to hit before taking action, they prepare long before trouble arrives. Those who adopt these wealth protection strategies can thrive in any economic climate, turning challenges into opportunities. While financial uncertainty may cause stress for many, those who follow these secrets will remain secure and ready to capitalize on new financial opportunities. The question is, will you be prepared when the next crisis comes? Start taking action today to protect your wealth and ensure long-term financial success. Like and subscribe for more insightful updates.